headlines, the RBI Governor maintained a status quo both in terms of the repo rate as well as reverse repo rate and maintained accommodative stance. The Governor commentary was fairly positive in terms of growth, and he also was fairly confident that the huge government borrowing will go in a smooth, non-disruptive and seamless manner even in FY22. In fact, if you look at the overall key highlights also, the Governor did mention that it is not just pent-up demand, and the demand is recovering and it is gradually moving towards sustained demand. In fact, if you look at the key highlights of the policy, the MPC voted unanimously to keep repo rate unchanged and maintain accommodative stance. This is for as long as necessary, at least to the current financial year and into the next year, in order to revive growth on a durable basis, mitigate the impact of the COVID pandemic, and to ensure that inflation remains within the target going forward. RBI projected FY22 GDP growth at 10.5%, and also the Governor stated that the Indian economy is poised to move only in one direction, which is upwards, and that he stated it is a strong conviction backed by forecasts that in FY22 we would undo the damage that COVID-19 has inflicted on the economy. So clearly the focus of RBI also remains pro-growth. In terms of CPI, well, the projections are 5% to 5.2% for H1 FY22. This is slightly, this is versus 5.2 and 4.6% in the previous policy. 4.3% is projected for Q3 FY22. This is in terms of CPI. The RBI also mentioned that in terms of liquidity, the liquidity stance continues to be accommodative, and it would be completely in consonance with the stance of the monetary policy. The RBI would ensure the availability of ample liquidity in the system and thereby foster congenial financial conditions for the recovery to gain traction. In terms of liquidity, RBI stated that they would be gradually restoring CRR in two phases in a non-disruptive manner. First to 3.5% effective 27th of March and to 4% effective 22 May 2021. They also stated that retail investments in gilts and HTM norms would be there in order to ensure smooth government borrowing. They've extended the dispensation of enhanced HTM of 22% up to 31st of March 2023. Also, they stated that the enhanced HTM of 22% would include securities acquired between 1st of April 2021 and 31st of March 2022. HTM limits would be restored from 22% to 19.5% in a phased manner starting 30th of June 2023. They proposed to provide retail investors with online access to GSEC market, both primary and secondary, directly through Reserve Bank of India Retail Direct. Governor stated that this is a major structural reform placing India among select few countries which have similar facilities. In fact, the Governor also mentioned or reiterated that the maintenance of financial stability and the orderly function of the yield curve were explicitly regarded as public goods, as the benefits accrue to all stakeholders in the economy. In fact, if you look at the bond yields, well, the bond yields had risen to as high as 6.14% immediately post the RBI policy, but it later did cool off slightly to 6.10% as we speak. The bond yield, of course, had risen close to around 18 odd bips immediately post the budget. So yes, a fairly positive policy coming in so far. How will the yield curve evolve over a period of time? We will have to see. But as of now, it seems that at least the rate cuts are unlikely to happen in the current year 2021, according to most of the economists.